Obviously, the goal of every business is to make money, and this is why many corporations are actually taking up tax planning to minimize the total amount of taxes that they pay to the government. But some of these companies have opted to shift their profits to low-tax jurisdictions to reduce this tax burden, a move that has denied Kenya its rightful share of taxes. In an exclusive interview with KTN's Adelaide Changole, the Kenya Revenue Authority tells us how they are going about dealing with this issue that has cost Kenya billions of shillings in the past.
Kenya sits in the middle of the African continent with easy access to all the major African cities. It also has a pool of skilled workers, a steady supply of power, and a relatively good transport system, all of which have made it a darling for multinationals looking to set up their regional offices. But while these firms have brought investments and created jobs, a few have taken advantage of the system to divert profits to countries with lower taxes, essentially denying Kenya its share, a term referred to as transfer pricing.
This is not just about the question of the fact that we are entitled to the money for tax, but also the morality of it, because if the money is generated in Kenya, if the business is generated in Kenya, then Kenya has a right to have the benefit that is provided in terms of tax revenues.
The argument most of these firms use is that they are just planning their taxes to limit their burden. In fact, a study by PricewaterhouseCoopers earlier in the year found that organizations throughout Africa were taking up aggressive tax planning to limit what they said was their huge and rising tax burden. And some of these have become very creative ways to beat the system.
The common practice you see is where business is invoiced through a company that is registered in a foreign jurisdiction, particularly the tax havens. You will also find that there are companies that buy through offshore vehicles. They could be their holding companies, they could be their parent companies, and in the process of buying items, it could be capital goods. Then there is over-invoicing.
And this has seen the country lose billions of shillings in the past. But the Kenya Revenue Authority is getting tough on these firms as it seeks to protect the country's tax base from erosion.
Before 2006, we did not have a transfer pricing legal framework. And but we brought it in 2006. We drafted rules and regulations. We amended the Income Tax Act to provide for it.
So far, this focus has yielded good results for the country, which has been able to recoup some of these monies.
We have done about 30 to 35 audits since 2009. And we've raised revenues of about 15 billion from that exercise. In terms of the cumulative adjustments to tax to loss positions, that we've done to the tune of about 50 billion.
But how does KRA choose which firm to audit and which one to leave out? The Commissioner General says the matter is determined purely by the way the business is structured.
So you've got to look at the structure to see whether there is significant business between the company and associated entities, where those associated entities are based, whether they are based in a low tax jurisdiction. And that is what tells you that there is a transfer pricing risk here.
But this approach has made the taxman look biased as it audits the same firms over and over again.
Today, you have taxpayers who will say that, look, you audit me every year, but I know you don't audit other people. So why me? And therefore, perceptions that you're being targeted, you're being treated unfairly, that others are being given preferential treatment.
And hence, when disputes arise, the companies opt not to negotiate with KRA and instead institute legal proceedings. But this is a costly and lengthy affair for both the taxman and the accused. And now KRA says it will be unveiling a faster and more efficient system.
We expect that within this financial year, we are going to establish a properly structured alternative dispute resolution mechanism within KRA. That will then mean that taxpayers can have recourse to a proper structure for dispute resolution.
Adelaide Changole, KTN Business.